there's a lot of demand now coming in for silver, and we haven't even talked about the major impact, which is going to be investment demand in the future. So there's a lot of perfect storms for silver in the future.
Hello again, everyone, and welcome to another edition of Silver Bullion Television, SBTV. I'm your host, Patrick Vieira, part of the outreach team of Silver Bullion here in Singapore, where we want to help you truly secure your wealth. Independent researcher Steve St. Angelo joins us today. Steve started to invest in precious metals back in 2002, and later on, in 2008, he began researching the areas of the gold and silver market that, curiously, the majority of precious metals analysts and community have left unexplored. And these areas include how energy and the falling EROI, or energy returned on invested, stand to impact the mining industry, precious metals, paper assets, and the overall economy. And we're delighted to have Steve St. Angelo join us once again today. It's time to saddle up and silver up for Steve St. Angelo. Steve, welcome back to SBTV. How are you doing?
Patrick, great. It's a brand new year. A lot of interesting things going. Always plenty to talk about. So it's great to be back.
All right. Glad to have you back again, Steve. Appreciate it. I want to start off by asking you about a piece by Dr. Chris Martenson, where he put out in reference to Doomberg's piece, The Peak Cheap Oil Myth. Steve, I just want to ask you here, is peak oil, as the title suggests, a myth?
Well, you see, that's there's a lot of debate now because of Doomberg's articles and posts on Substack and on Zero Hedge and the alt media. And so Adam Taggart did an interview of Doomberg, follow-up. And so that's where it started. I kind of retweeted that. Well, I disagree. And then Chris Martenson said, I'm coming out with a post tomorrow on that. And he did a great job showing the facts why peak cheap oil is not a myth. And there's a chart that I have. It shows, it breaks down all the oil production. And if you look at just the silhouette of global oil production, all petroleum, it doesn't look like it's peaking. So it looks like we got it wrong. But if you look at the conventional, that's the high quality, high energy return on investment, cheap oil to produce. If you look at the chart, it shot up in the 60s. That's why we had $1.80 for a decade of oil. And then we hit a peak in 2006, and by gosh, Patrick, we have not surpassed that peak. We've brought on oil sands, we've brought on more condensate, we've brought on tight oil, and a lot of natural gas liquids from shale, but these are not really oil. And so I think people need to understand, if there was peak cheap oil, then we would not be going to the Arctic. We would not be going to deep water to get oil, because there's a lot of talk about abiotic oil producing all this oil. And if that was the case, if there was all this oil just to keep replenishing on land, why did Russia go to the Arctic? To deal with that kind of environment, climate, to get oil and gas. And why are we going into like Deepwater Horizon? We had that massive blowout. So no, I think if you look at the numbers, we are not finding that much more conventional oil, the cheap oil. We're just not. And we're still spending a lot of money. So the facts show that, the data shows and the number shows that no, we're not finding much inexpensive oil. We are bringing on expensive oil, and that will likely peak in the next several years.
Okay, that's a pretty important point, expensive oil, because there is a phrase that energy is the economy. So Steve, do you agree with that phrase? And how would you explain energy is the economy?
Well, I always kind of innately understood that. But then when I got a book, one of my followers told me about a book called The Forest Journey. And that's an excellent book going back all the way to the late Bronze Age and the Greek Empire and the Roman Empire. And it shows how we used wood fuel back then to produce metals, and that was basically the wood, the fuel of the economy, as long as with slavery, a lot of slavery back then, and human labor. But we've replaced that with oil, natural gas, and coal. So the thing is, if you go back and look at these past histories, the boom and bust, the huge increase in these civilizations was due to the massive increase of their fuel production. And when that got into trouble, when we had a peak of their energy return on investment of their wood fuel production, that's when the economy starts to decline. And so there's nothing new. History books show us this has happened many times over and over. So when people say that we're not going to run out of oil, but we have run out of energy sources before, and we are definitely peaking in conventional, and soon we're going to be peaking in unconventional. It may plateau for a while, but there's a lot of data showing why that's the case.
Okay, and I believe Dr. Chris Martinson, he also said that if you want more economy, you're going to have more oil being burned, and this, I guess, this kind of ties into to what you were saying. But what's your opinion on this? If we do want more economy, are we going to have to go back, let's just say, and get more oil?
Well, yes, because John Mark Jonkovic did a presentation in front of the OECD showing there's a direct relationship between oil consumption, global oil consumption, and real GDP growth per capita. And so the thing is, even though this is 3-year averages and it's kind of averaged out, oil allows us to drill natural gas wells, diesel trucks and equipment, and the same thing with coal. If you want to have an elevated coal production, I'm not talking about when England started producing a lot of coal and then the United States started producing a lot of coal in the 1800s. That was the industrial age. That was done by a lot of human labor, animal labor. But then when you brought on oil, you could use massive machines to extract coal and then transport it. So if you want to have elevated natural gas and coal production, you have to have the oil. And so this is the foundation of the global economy. The global supply chain is oil. So when that starts to contract and decline, so will, in time, the other energy sources. And the GDP. Economic growth will also decline. It goes hand in hand.
If you're enjoying this interview with Steve St. Angelo and I, please consider subscribing to our YouTube channel. And if you would like to learn more about wealth protection, please do visit our website at www.silverbullion.com.sg. Yeah, you answered my next question there pretty well, where I was going to ask you about the relationship between GDP and energy. So I guess we can move forward a bit, and I'll ask you about this JP Morgan Commodities Insights report. JP Morgan, their research estimates that global oil markets, could face about a 1.1 million barrel per day deficit in 2025, just around the corner, and widening to about 7.1 million barrels per day in 2030. It goes on to say that we believe the global economy is able to withstand triple-digit nominal oil prices, as in real terms, prices remain below the peak levels we saw back in 2008, 2011. The thing is, knowing that there simply is just not enough oil, will renewables such as wind and solar be able to make up for this oil shortfall, which we can translate to an energy shortfall?
The long of it is no, and the short of it, yes, kind of, because we're adding more wind and solar, and so when that's working, that is cutting down what you have to burn, either natural gas, either nuclear or coal. Even hydro as well. So when you're ramping these up over the short term, you don't have to use oil, natural gas, and coal or hydro to produce electricity. So it is replacing some of this supply. The issue is we have to understand from 2005 to 2022, the natural gas, oil, and gas, nat gas, oil, and coal production increased 3 times the amount of wind and solar. So you need to burn the oil, natural gas, and coal to be able to make the wind and solar. If you don't have the growth in oil, natural gas, and coal, it's very difficult to make the wind and solar. Now, if the global economy goes into a recession and we don't spend as much of our energy or money or income on, let's say, more luxury items or vacations, and we instead put that into maybe producing more solar and wind, well, we could ramp it up for a while, but that gets into trouble as oil production starts to decline. So the thing is, when we start to peak and decline in oil production, then we're going to see GDP roll over. Now, the central banks may issue a lot more treasuries and debt to inflate the GDP. And, you had brought up a good question that we did skip over. And I want to talk about that now because I have a chart showing US GDP, energy consumption, and debt going from 1950 to 2022. And you'll see from 1950 to 1980, energy consumption and GDP go up in the same trend. After 1980, we started importing more oil. Guess what? The debt started to increase. US public debt was going up. And so we started to actually peak and hit a plateau in our energy consumption. But the GDP kept going up. Guess what, Patrick? It was going up, and you can see it in the chart from 1980 to about 2008. It was going up in the same tandem as the debt increase. So debt now was driving, more of the GDP. After 2008, when the US debt surged higher, skyrocketed, GDP kept going up, but it took a lot more debt to increase that GDP. So it's very important to understand a lot of the GDP now is being inflated by the massive amount of debt that's in the system.
Okay, that's a great point. Thanks for bringing that one up. I want to slide over a little bit into these renewable energies, which include solar and photovoltaic energy. Silver is used in these, and we are already seeing where demand for silver used in solar and PVs or PV technology is outpacing supply. Reports from Silver Institute and as such, where silver is heading into even a deficit. In your opinion, Steve, because I know you're well versed in both energy and precious metals, do you see silver heading into a deficit or a shortage?
That's a very detailed question because it depends on where the shortage is or the deficit is. According to the Silver Institute, Metals Focus does the analysis for the Silver Institute. The deficit happens when you look at mine supply, recycling, and then you have all the demand. And then there's a surplus deficit, and then you've got ETF demand and over the counter. And so the thing is, when you get a lot of ETF demand, that can absorb a lot of silver from the market. And we had that in 2020 during the pandemic shutdown. A lot of silver moved into the ETFs. So we had big deficits. So they're continuing to see these deficits. The issue is we need to understand there's about 1.3 to 1.5 billion ounces of silver held in the LBMA, in ETFs, the COMEX, and other vaults around the world. And there could be even more, but that could be tightly held silver. But what would happen if we have more deficits in 2024 and 25? That will start eating up some of the silver. And we saw this happen last year when Indian demand really took a lot of silver from the LBMA. The LBMA silver inventories really fell in 2023. Now, another important factor is solar PV, because in 2022, the Silver Institute, there was about 140 million ounces of silver that was used in PVs in 2022. In 2023, they forecasted 160 million ounces. Do you know when they came out with the interim report in November, it's almost 190 million ounces for last year. So it increased 30 million ounces more than what they're forecast. And if we get even higher demand for silver for PV in 2024 and 25, it's probably going to be over 200 million ounces. So yes, there's a lot of demand now coming in for silver. And we haven't even talked about the major impact, which is going to be investment demand in the future. So there's a lot of perfect storms for silver in the future.
Right. With that much higher demand, I mean, of course, we have to be concerned with supply and as you mentioned, investor demand. Uh, Steve, do you see that silver pie growing where investors will still be able to have a nice slice of that silver pie?
Well, do you know there is a lot of silver in jewelry and in art forms, and we held privately that we may not know about. So we could have when silver prices really go up, we could see more silver scrap supply, recycling. But even when we hit $50 silver in 2011, and it was very high in 2012, we didn't really see a massive increase in recycling. We had some, but not a massive increase. So I think, though, the bigger issue is the problem that the world is facing with energy is there's way too much finance, Patrick. And in time, we're going to, I call it, we're going to see a global Bear Stearns Lehman Brothers event with the 500 trillion plus trillion in overvalued financial assets. And so when this starts to happen, it'll take time. When the psychology of the investor wakes up, they need to protect their wealth. They really can't do it in financial assets. So that's when I see a movement into silver, and there less than 1% people buy silver. So yes, when we start getting more demand into silver to protect wealth, that's when there won't be much of a pie. The pie is way too small. So at most, there's 5 billion, 6 billion ounces of available investment silver in the world. I mean, that's like $60 billion worth of silver. It's just not, well, let me do that math again. No, that's about 125, 130 billion worth of silver. And the U.S. government just issued 2.5 trillion in new treasuries in the last year. So these are very crazy figures. So at some point in time, this energy is going to change the dynamic of the market into real assets, physical assets.
Right. I guess, speaking of the dynamics of the market and energy changing it, uh, when we look at these new renewables, uh, let's just say the PVs, let's just say wind, solar, these types of renewables, they let's just say they renew so-called electricity, energy, things like that. But oil is more than just that. I mean, we see oil in plastics, lubricants, MRI machines, pacemakers. So and more. So even if we should switch over to renewables or let renewables to try and take the place of some of the oil, are we truly going to be able to get off oil as a lot of people are preaching here?
No, we'll be forced to, because the supply, there's only so much supply. And the data shows it. And nothing lasts forever, unfortunately. And so it wasn't a renewable source. Oil was not a renewable source. And so the issue is that's going to peak and decline. And so the ability to use it as transportation, which is a very important part of the global supply chain, right? Getting things around the world quickly. It's also produces a lot. I mean, even EVs like Teslas, they got a lot of plastic in them, right? I mean, so they're lightweight. You make those with plastics. And so, there's no way around producing the thousands of products that we use today without oil. Now, some of it is natural gas liquids. We make a lot of plastics with natural gas liquids, but that supply, it'll peak after oil, but that is not unlimited as well. So this is the issue. There's no way really to and tires, right? Tires are made of petroleum. So there's no way to replace oil, to totally replace oil, unless we, go to a much different technology, which we haven't even invented yet. And if we wanted to, we should have done that 20, 30, 40 years ago.
I mean, Steve, let's say, yes, we are at peak oil. I mean, what happens to the economy? I mean, do we see it just run away in debt?
The issue, and I spoke at the Silver Symposium back in October at the Caesars Palace, showing a very important chart. Since the global financial crisis, Patrick, the world has added 281 trillion of financial assets everywhere. Pension funds, mutual funds, money market accounts, it's insurance, it's everywhere. Shadow banking assets. Over that same period, the GDP in the world has increased 28 trillion. Financial assets have increased 10 times the GDP. Now, the oil supply has increased 13 million barrels a day. So when you look at that chart, the GDP is a bit inflated, but what we need to understand is that we have just enough energy to produce all the goods and services, the cars, the homes, the clothes, the food, everything that we buy and sell on a daily, weekly, yearly basis. That's all the energy we have. We don't have energy to settle 500 trillion now of outstanding financial assets. So when oil production starts to decline, even though GDP, real GDP, let's say uninflated GDP, starts to plateau and decline, the financial assets are in serious trouble, because that's the problem. And that's the reason why the investors need to be in real assets, especially the precious metals. So yeah, there is no plan B. We could remain in a bit of a plateau for a while as we bring on as much of this unconventional energy we can to continue business as usual. That can happen, but that's still not going to help the highly leveraged, overvalued financial assets. And I can't warn the market and investors enough about that problem, that predicament we're facing.
Yeah, completely agree. So I think this is where I know you've often tried to stress that point where gold and silver, they are definitely tied into to energy. So I guess we're right back here again.
Yeah, and I wanted to add something to the conversation. I put out an article called The Great EIA Oil Bamboozle. And what they're doing now, and I was quite shocked. In July, U.S. oil production took off, and it hit a new high of 13.3 million barrels a day. But a lot of the people, like, in the oil industry and the analysts, were looking at the shale, and the shale production was kind of rolling over or plateauing back in June, July. They didn't know where it increased 700,000 or 800,000 barrels a day. Well, the EIA is now doing hedonic adjustments like the U.S. government does with inflation. If steak is too expensive, then you can eat, they'll substitute ground chuck. And if ground chuck is too expensive, they'll substitute, a gravy train by the dog food. I'm making a joke here, but they're doing the same thing now with the oil production. They've added 700,000 barrels a day of other oil, mostly natural gas liquids. And they actually say it in the data. It's called transfers to oil supply. So what they've done since July of last year, they've added 700,000 barrels a day, mostly of natural gas liquids. Natural gas liquids is petroleum. It is not oil. So they're using it, and so natural gas liquids should be shown as natural gas liquids. But again, they're showing crude oil and condensate, which is about 12.5 million barrels a day. That's probably where it is. But to the world, we're producing 13.2, 13.3, and we've added natural gas liquids. And so I think this is a similar thing that the U.S. government did with inflation on goods and services to show a lower inflation rate, hedonic adjustments. And we're seeing the same kind of insanity now taking place in the oil market. So I just want investors and your followers to understand this is what they're doing to try to kick the can down the road and to make it seem that we're producing more real oil than we are.
All right. Well, hey, at least they're consistent, right? I mean, we can always count on that from them.
That's right.
So,
They're consistent.
we'll give them that. But Steve, for all the average guys out there, the investors, I mean, how do we really start to recognize that? I mean, something around us will let us know that we've reached peak oil. I mean, is there something that we're going to see, we're going to hear, we're going to experience?
Well, in that chart I talked about in the beginning, we hit peak conventional in 2006. Peak conventional hit in 2006, plateaued, declined in the pandemic, came back up, and it's still about 3 million barrels less than it was in 2006. Even though we've ramped up natural gas liquids, tight oils come on. So it looks like there's like 100 million barrels a day of production. So to someone who doesn't look at the numbers, the detail, we already saw peak conventional. And I do not believe we're going to see conventional overtake to 2006 because we're consuming a lot of the oil discoveries. Peak discoveries, get this, peak U.S. oil discoveries on the United States happened in 1935. Peak discoveries in the world, when you include the Middle East, happened between 1950 and 1970. And we're burning up those past discoveries. And we're not adding much new ones, even though we're doing a lot of green energy. So what you'll notice conventional production starting to decline, and you'll know it when unconventional, shale oil and other energy sources when we're seeing lower production. Now, we could have a recession. I think we're going to see a recession this year, Patrick, in the United States and globally. That can kind of push things back a little bit because there's less demand. So I think the evidence is there. We have already seen peak conventional. When you start seeing peak unconventional, which will likely happen after 2023, the real numbers, then that's when people will know it. And you have to also lastly remember, U.S. shale wasn't possible without zero interest rates, because all that production cost a lot of debt, and that wasn't feasible at high interest rates. So even though we have brought on a lot of shale oil, a lot of unconventional, this is not something that's sustainable due to all the massive debt and money printing. If we didn't do the massive debt and money printing, propping everything up, then I could say, yeah, we could probably continue for a bit longer, 5 years, 10 years. But no, there's been too much debt propping up the system. And when that starts to roll over, then the production will also start to roll over much quicker. So that's how I see it. That's how people can start to notice it.
Steve, I appreciate the insights that you've given. Quite a lot to think about. Before we wrap up, can you tell us how we can follow your work and follow you on social media?
Sure. And Patrick, thanks, because, what we just talked about, most of these subjects, we can talk 2 hours, because the details, the devil is in the details. And so it's important that people really understand the details. And that's what I like to do at the SRSrocco Report. We've got the memberships to show how this is updating every day or every week. I do updates on how this is changing. I'm also on Twitter, SRSroccoReport.com at Twitter, because I like to put out some of this information. I think if you really understand what's happening with energy, you'll get everything else. Unfortunately, most economists, most people they ignore energy, and they do so at their own peril. So thank you very much. I appreciate you allowing me to share this information with Silver Bullion TV followers.
All right, thanks, Steve. Appreciate it. And yeah, I'm one of those guys who, we're so focused on the economy and precious metals, we absolutely forget or don't take notice to the oil and energy market. So we need more guys like you to come out and talk about these things and help us understand. So I appreciate that.
Sure. And let's do this again, maybe in the middle of the year, and see how things play out, because the energy cliff, I call it, is going to be very price volatile. You get highs and then you get lows. And that's just going to get worse as time goes by, due to the inability to grow production enough. And so you're going to have a lot of volatility with trading and with going through surpluses and then going through deficits, shortages. And that's what happened in Europe. They had shortages of natural gas, and then they went to a surplus. And that's going to come back around to haunt them again. And so these things take time to play out. It's not going to happen overnight, but it's going to become much more volatile as time goes on.
All right, we'll take notice of that, and we'll look forward again to having another interview with you. So again, thank you for your time, and let's do this again. That was Steve St. Angelo sharing his insights on oil, energy, the economy, and precious metals. To see more of Steve's work and the services he provides, go to SRSroccoReport.com. If you like this interview, please give us a thumbs up, subscribe, and share it on your social media platform. Audio-only versions of this interview can be found on iTunes and Spotify.